Hey everyone, welcome to the GMT channel of loan syndication series. Today we'll discuss the difference between the CLO and CDO, understanding the different contexts, why this is different product with each other. So if you are new here, don't forget to hit the subscribe button, turn the notification for the regular update, because on weekly basis we are releasing more than 5 videos in this channel with different topics. So if you are new, please hit the subscribe and like button and share as well. So today, as discussed, we are diving into the CLO and CDO different between. So what they are, how they differ, and why they matter into world in the finance. So let's start the topic with the GMT channel. So defining the CLO and CDO. So CLO and CDO, the main difference is between the L and O of CLO and CDO. So L means the loan and D means the debt. So loan are taken from the, for CLO, the loan are taken from the corporate loan. So corporate loans means the MBS, ABS, we can say that through the car loan, auto loans, credit card, student loan and home equity. So they combine this loan of various type, and they securitize means they pool all the money at one go. Like this, this product will work. For CDO, the main difference is a debt instrument. They collect all the debt instrument, like maybe the bond, loans, receivable, maybe the small thing like equipment financing, bridge financing, overdraft, letter of credit, term loan, project finance, infrastructure finance. So they are collecting all the debt obligations and they securitize into one pool. So this is the main difference between them. So now moving to the next purpose, underlying asset and purpose for this. So that comprise the cooperator particularly for the leverage loan. So leverage loan means what we can say, for the low credit rating and high debts level. In the part we give the example as well, is for the mergers and acquisition, recapitalization, corporate action activity. So why this is done through the corporate loan, and designed to help to banks to manage credit risk and free up the capital. So most importantly, SDFC and ICICI are playing the role, and SBI also playing role in the CLO part. For CDO is comprises with the mix of debt instrument, including the corporate bond, mortgage, as I discussed, as a corporate bond, mortgage backed security, MBS, ABS, and collectively create the high yield investment opportunity for pooling the diverse debt asset. Moving to the next, the risk profile as well. If you are the investor and you want to invest into this particular product, so there are some risk profile as well. So generally, for CLO is a low risk profile due to the higher repayment priority for of a corporate loan. So if corporate loan, as we discussed in our previous video of CLO example, so most of the reputed company are issue the corporate loan like Reliance, Adani, Wipro, or maybe other corporate one. But they are giving the timely payment to the what they have taken from the investor. So that's why this is a low risk profile, and high payment repayment means they are giving the payment through the interest to the investor. So it is a high. But in CDO side, it is a higher risk profile due to the exposure to the subprime asset for lower rated security. So what you mean by subprime asset? So poor rating history of that profile has called as a subprime asset, who considered as a high risk for the default. Like some product are the MBS, ABS, student loan, so are considered as a subprime asset. Include the securitization of a corporate bond, mortgage, and other receivable, making it more diverse but potentially riskier. So why it is riskier? Because it's completely into the this product is designed for the debt only. So debt are really difficult to measure or accounting or maybe do the structure on this product. So this is a part of difficulty in the CDO. So investor base and global adoption. So now how is trending into the global, how is trending into the Indian market? Let's discuss this part also. So attract investors who seeking exposure into corporate credit market with predictable cash flow, widely adopt globally, particularly in US and Europe, and growing in India. So now it start with the US and Europe, but particularly now growing activity into the Asia. But in Asia, few are the players who are working. Like Reliance is taking the corporate loan for his oil and refinery sector, for his telecommunication sector. At the same part, Adani also taking the corporate loan for his airport building, infrastructure, renewable energy sector. And same like IRB is raising the money for the national highway is a CLO example. But in CDO, only in India, it is released into the 2003 with ICICI released this with 506 crore like this. So it's peaking the peak in the mid of 2000, but actively declined silently after the global crisis in 2008. So due to global crisis 2008, it decreases his existence in the market. Performance during the crisis in an Indian market presence. So let's discuss when the crisis has happened. So how this product sustain into the market. Perform actively well during the 2008 crisis due to better quality underlying asset and structure risk distribution. So same like if some crisis has been still there, but this CLO keep his existence into the market due to they have underlying asset is very good, and the powerful company are investing, like reputed company are investing. So investment doing this corporate loan activity. So due to this CLO existent in the market. But in CDO, sorry, I forgot to explain on the CLO part. So it's limited adoption with the nascent market and on this part. So what is nascent market? So nascent market is a new market in which early stage of development. So I give the example of Adani and Reliance, how they are investing. So they are investing into the early market. So renewable energy market is not is a developed market in India, or we can say telecommunication sector play the revolutionary good role into telecommunication sector. So they are not developed, but this product helps to develop the new project. So that's why it is important on this part. But CDO, we can say that the face significant loss during 2008 crisis due to particular backed by the subprime mortgage, because his job underlying asset is not a strong point on 2008 crisis for CDO, because they consider MBS, ABS, student loan, and very riskier product they have underlying asset. Due to that, they have not sustained into market very effectively. Early example of this is ICICI 2002 exit, but CDO not gain significant traction in the Indian financial landscape. Due to this fund also not perform very well. So now the tranches structure and example of this. Okay, so CLO tranches based on the priority of a loan payment, while senior margin and equity. So when the payment has been released from the borrower who has taken the loan to investor, so most probably they give the first priority to the senior and margin and equity. But in CDO the same thing is follow, but the risks depend heavily on the mix of underlying asset and their quality, because this product is very complex to calculate, evaluate, or maybe do the accounting. So sometimes whatever the interest they have promised, they cannot able to do that. So here we give the example of Reliance, and here the ICICI. Already we have discussed this part. Moving to the next slide. So key takeaway and the conclusion from this is the focus is security corporate loan and are preserved as a relative safer investment, making attractive the conversion invention. So CLO attract more to the investor as a part of a as a part of investment. But on other hand, if we check CDO is attract less due to 2008 crisis and due to his underlying asset are the debt one. So due to is not taking consideration in Indian market. So while CDO has limited experiment has been done, but CLO are the emerging tool for managing corporate credit and fostering market growth. So this objective of this PPT is to explain you between CLO and CDO. Most of the audience are just comment us is the same term how we differentiate. So we differentiate accordingly. But just to advise on this as a final takeaway on this part. So if you are an investor, CLO might be the safer due to the corporate loan backing because they invest into safer part. But if you are willing to take the more risks for potential higher return, so you can go to the CDO part and invest on this part. As always, do the research and consult with the financial expert before investing. If you found this video helpful, give the thumbs up and share it with your friend. Let me know in the comment which topic you like me to cover next. Thank you for watching this and we'll see you in the next one. So thank you so much.